February, it's a new month in 2026. We're going to look at some top stocks to buy, both growth and safety stocks for our portfolios in 2026. Now, we're going to base all of these off of positions that we already hold. So across our three different portfolios that Interflame Finance manages, we're going to look at all the holdings and we're going to rank them on growth and we're going to rank them on safety. Now, your time is valuable to us. So what we've done is we've eliminated all the companies that have low scores, and we've eliminated all the companies that don't have a 20% or higher margin of safety. So Adobe's coming in with a PEG ratio of exactly 1. That's very nice to see. Remember, we like PEG ratios to be 2 and under. 1 and under is a fantastic opportunity, possibly. We're going to see some of the best forward PEs with Adobe coming in at 11.8. Return on equity, some of the best we're going to see today at 55.4, and a free cash flow yield at 8.2%. Next, we're looking at CPRX. This is the pharmaceutical company. They have basically no debt to equity. Their return on invested capital is 57%, and they have the second best free cash flow yield coming in at 7.9%. Next up is Salesforce with a pretty decent PEG at 1.1. 5-year forward PE coming in at 12.3. So compared to the other two that we've seen so far, that's a little on the high end. Not too fantastic free cash flow yield. Remember, we like to see that 7% or higher. But they are expected to grow their EPS, their earnings per share, each year 18% for the next 5 years. So that's pretty nice. EXEL, another pharmaceutical company, coming in with a PEG ratio not just under 1, not just under 0.5, but coming in at a 0.4. That is phenomenal. Their forward PE is coming in at 13, but if they can execute on 7% growth every year for the next 5 years, you're getting EXEL right now at a 5.2 PE ratio in 5 years. So that is phenomenal. First Solar, this might surprise some people, a solar company coming in as one of the best growth companies in this climate of scaling back our green energy initiatives. But as Warren Buffett would say, be greedy when others are fearful, be fearful when others are greedy. Solar energy, wind energy, renewables are probably the wave of the future, and we're going to bet on that with First Solar. They are the largest solar company in the United States. PEG ratio coming in at a 0.3. Forward PE coming in at a 10.2. That's just fantastic. And a 5.6 for their 5-year forward PE if they can grow 25% each year for the next 5 years. NVDA coming in with very solid numbers, as always. Return on equity, 107%. Return on invested capital, 115%. They're expected to grow their revenue and their EPS at some of the best rates that we see all day today. And finally, Pinterest coming in, basically no debt to equity. Profit margins coming in at almost 50%. That is fantastic. It is a software company. They are just an application. So you would expect profit margins to be pretty high in a company like that. Revenue growth coming in at 12.8%, second best that we see, and a 3.3 5-year forward PE if they can grow 18% every year for the next 5 years. So we're going to take a look at the growth scores. Before we do that, just a reminder that if you get anything out of these videos, if you appreciate what we do, please like this video. And if you want to keep coming back for more content like this, feel free to subscribe to the channel. We enjoy serving you and putting out this information and showing you our methodology to give you some ideas for your own portfolio. That being said, nothing that we say is financial advice. We are not telling you to buy, hold, or sell anything in your personal portfolios. Always do your own research and your own due diligence before buying, holding, or selling anything in your stock market portfolio. So we're going to start at the bottom and work our way up. Remember, we like to score companies between -10 and +10. -10 is absolute garbage. +10 is one of the greatest companies in the world. Just because we have a lot to go through today, we're taking everything that's below a 5 and we're throwing it away. So all these companies are scoring 5 or higher in the growth category. And so Salesforce coming in at the very bottom at a 6. Adobe coming in at a 7. We have NVIDIA coming in at an 8. We have First Solar also coming in tied at an 8. CPRX coming in at 8.5, Pinterest coming in at a 9, and EXEL almost a perfect score coming in at a 9.5. So these are fantastic companies, and we will likely add to these in our portfolios in the month of February. Not only is it important to buy companies that are quality, meaning they have good scores in our scoring methodology, but we want to make sure that we get these companies at a good deal. And so what I have here is the intrinsic value calculator models. We've built them out on the channel. You can find links in the description of this video. There's the PE ratios model, there's a dividend discount model, there's the standard discounted cash flow, and there's the Peter Lynch model. And you can see that we've done these for Google. Because these are growth companies, we're not going to look at dividend discount models because they don't offer any dividends at all, or if they do, they're very low. That being said, all the companies that we're looking at today, we're looking at a PE ratio model and a discounted cash flow model for them to make sure that we're not just getting quality companies, but we're getting them at good prices. Remember the saying, it's price is what you pay, but value is what you get. We want to make sure that we're getting a good value for our dollar. And so for these growth companies, we have CRM coming in at the very top with an average score of 6. Intrinsically, we think Salesforce is $280. Their current price is $212. That gives us a nice, healthy 24% margin of safety. Typically on this channel, we prefer margins of safety 20% or higher. All these companies are going to fit the bill for that because we want to get down to it and make sure we're not wasting your time. Adobe coming in next with an average score of 7. So a little bit better of a growth company than Salesforce at this point. Intrinsically, we think that they're worth $432. They're currently trading for $293. That gives us a 32% margin of safety. First Solar coming in with a score of 8. Price $226. We think intrinsically they are worth $338. Margin of safety coming in at a 33%. NVDA also a wonderful addition to our portfolio over the past couple of years. The current price is $191. Intrinsically, we think that they are worth $260. That gives us a 26% margin of safety. CPRX with a score of 8.5. They're currently trading for $24. Our intrinsic value calculations put them at a $31 mark. And that gives us a 22% margin of safety. Pinterest, currently trading for $22 per share. Intrinsically, according to our calculations, coming in at $45 per share. Now, their score is a fantastic 9 in the growth category and a margin of safety of 51%. And finally, the last company for growth is EXEL. They are currently trading for $41 per share. We feel that they are really worth around $70 per share. That gives us an average score of 9.5 and a margin of safety of 41%. So I won't go through all these numbers here on the right-hand side, but if you want a 15% discount, this is when you would start buying these companies. And I believe they all fit the bill for buying. You want to buy heavy when they are at a 35% discount or greater. And so we're going to get now into the safety companies and see how they stack up. Then we're going to start with Bristol Myers Squibb. Return on invested capital is coming in nice at 14.6%. Dividend yield at a nice 4.5%. They have grown their dividends for 19 consecutive years, and their 5-year forward PE is a 1.2. So their current PE is 18.6, but if they can grow according to analyst expectations, they're going to come in at a 1.2 5-year forward PE. So that is a bargain for Bristol Myers Squibb. DHI is a home builder. They have very little debt to equity. Their dividend growth is 21.4% in recent years. They've grown those dividends for 11 consecutive years. Their payout ratio is a healthy 14.6%. So we like to see that. That means that they can not only maintain their dividends, but probably, hopefully, grow them in the future. Free cash flow yield coming in second place at 8.1%. Elevance, the insurance company, health insurance, 15 consecutive years of dividend growth with a 3.8% dividend growth in that 15 years. Their dividend yield is currently 2.0% even. And nothing too fantastic about Elevance. We've covered it several times on the channel in comparison to United Health. Gilead Pharmaceuticals, that's a return on assets of 13.5%, return on invested capital, the best of all these companies at a 21.5%, a phenomenal 2.75-year forward PE if they can grow. However, we look at that payout ratio, not only above 100, but over 400. That's not a good sign for their dividend growth, so that gives us some pause. And their 5-year, or rather their free cash flow yield coming in, unfortunately, under that 7% mark at a 5.2%. Lennar is another home builder. Their payout ratio is a very healthy 25%. Haven't grown their dividends much, but their dividend yield is 1.8%. The current PE is 13.7, which is quite nice, and very low debt to equity. And finally, Mondelez, we have dividend yield of 3.4%. For 12 consecutive years, they have grown their dividends. Their payout ratio is getting a little high at 62%, but they are expected to grow those dividends at around 8%. They do have a rather high 5-year forward PE, 18.7. That means that while their PE is currently 21.8, that does expect to come down, but not too much growth baked in to their future. Gilead coming in at a 5. Elevance coming in also at a 5. Bristol Myers coming in at a 5.6. And probably a 5.6, mainly because that payout ratio is an 83.8%. Not too fantastic there. And also they have relatively high debt to equity. So they have $2.80 of debt for every $1 in equity. So Bristol Myers, there are some red flags in that company. Lennar coming in also at a 5.6. Mondelez coming in also at a 5.6. And the top of the leaderboard is DHI coming in at a 7.5. So we ran intrinsic value calculations for these companies, and we also included the dividend discount model because these are all dividend payers. And so we have three different models when considering intrinsic values. So first we'll talk about Elevance. They come in at an average score of 5 because their safety score is 5. We're only looking at safety scores for these companies. The current price is $346. Intrinsically, we think they're worth $450. That gives us a 23% margin of safety. Gilead coming in also at a 5, currently trading for $142. Intrinsically, we think that they are worth $180. That gives us a 21% margin of safety for that company, just over that 20% threshold that we require. Bristol Myers coming in at 27%, intrinsically $75, we believe. That can hold up with an average score of 5.6. Their current price is $55. Lennar, the home builder, if the housing market unfreezes and we start to see home building and home buying, the current price of $109 would hopefully go up to $147 per share. That gives us a 26% margin of safety. Mondelez, average score of 5.6, price coming in at $58 per share. Currently, we think that they are worth $87 per share. That gives us a nice 33% margin of safety. And the top of the leaderboard is DHI, coming in with an average score of a safety score of 7.5. They are currently trading for $149, and we think that that can get up to $205 within the next year. So these 6 companies are potential buys and potential adds in our Interflame Finance portfolios. They have fantastic scores, 5 or higher. They have margins of safety, 20% or higher. So let us know in the comments what you think about these 6 companies. What do you think about the 7 growth companies that we talked about? We'd love to have that discussion with you. Again, please feel free to like this video, subscribe to the channel to keep coming back for more intrinsic value and scoring calculations for these companies. We appreciate you being here, and we'll see you in the next video.